quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Most people believe trading is something you either understand or you do not. They assume it requires a background in finance, years of experience, or some kind of natural talent. That belief is not just incorrect, it is one of the biggest reasons people never even begin. The reality is that every professional trader started exactly where you are right now, with no experience, no system, and no real understanding of how markets actually work. What separates those who eventually succeed from those who fail is not intelligence or luck, it is structure. It is the willingness to approach trading as a skill that can be built step by step, rather than something to rush into blindly. This is where most beginners go wrong. They jump straight into placing trades without understanding what they are doing, why they are doing it, or how to manage risk. That approach almost always leads to losses, frustration, and eventually quitting. This video is designed to remove that confusion entirely. The goal here is not to overwhelm you with complex terminology or advanced strategies. Instead, the focus is to give you a clear, structured path from absolute beginner to someone who understands how trading actually works at a professional level. Not in theory, but in practice. Now, this is critical. Trading is not about predicting the market perfectly. It is about managing uncertainty in a structured way. That shift in thinking changes everything. Once you understand that trading is a game of probabilities, risk control, and consistency, you begin to see why most beginners struggle. They are trying to win every trade instead of building a process that works over time. By the end of this, you will understand what trading really is, what skills actually matter, and how to begin the right way. Not the fast way, not the easy way, but the correct way. Before placing a single trade, it is essential to understand what trading actually is. At its core, trading is the process of buying and selling financial instruments with the aim of making a profit from price movements. That might sound simple, but beneath that simplicity lies a complex system driven by economics, sentiment, and global capital flows. Markets move because of imbalances between buyers and sellers. When demand exceeds supply, prices rise. When supply exceeds demand, prices fall. Every single price movement is the result of that dynamic. However, what creates those imbalances is where things become more interesting. Factors such as interest rates, inflation, economic growth, and global risk sentiment all influence how participants behave. This is where most beginners misunderstand the game. They think trading is about finding the perfect entry point. In reality, it is about understanding why price is moving and positioning accordingly with controlled risk. That is a completely different mindset. Another key point is that trading is not investing. Investing typically involves holding assets for the long term based on fundamental value. Trading, on the other hand, focuses on shorter to medium term price movements. The time horizon is different, the objectives are different, and most importantly, the decision-making process is different. Now pay close attention here. Trading is not about certainty, it is about probability. No trader knows what the market will do next with certainty. The goal is to identify situations where the probability of a particular outcome is higher than the alternative, and then manage risk in a way that ensures losses are controlled while profits are allowed to grow. Understanding this concept alone puts you ahead of the majority of beginners. Once you understand what trading is, the next step is understanding what you actually need to get started. The mistake most people make is overcomplicating this stage. They believe they need expensive software, complex indicators, or large amounts of capital. None of that is true. At the most basic level, there are only 3 things required to begin. First, a trading platform. This is the software that allows you to access the market and place trades. Second, a broker. This is the intermediary that connects you to the market. Third, a basic understanding of how price moves. Now this is where discipline begins. Just because you can open a trading account does not mean you should immediately start trading with real money. In fact, doing so is one of the fastest ways to lose capital. The correct approach is to start with a structured learning phase followed by practice in a simulated environment. A demo account allows you to experience the market without financial risk. It is not about making profits at this stage. It is about understanding execution, learning how trades work, and becoming comfortable with the mechanics of trading. This is where you begin to build familiarity. However, this stage must be taken seriously. Many beginners treat demo trading casually because there is no real money involved. That mindset defeats the purpose. If habits are poor in a simulated environment, they will be even worse when real money is at risk. The objective here is simple. Build correct habits early. Learn how to think, not just how to click buttons. After understanding the basics and setting up the right environment, the next step is learning how to read the market. This is where most beginners feel overwhelmed, but it does not need to be complicated. Price is the only thing that matters. Everything else is secondary. Indicators, tools, and strategies are all built on price. If you do not understand price movement itself, everything else becomes noise. Markets move in trends and ranges. A trend is when price consistently moves in one direction, either higher or lower. A range is when price moves sideways within a defined area. Recognizing these two conditions is one of the most important foundational skills in trading. Now this is critical. You do not need to predict every move. You need to understand the environment you are operating in. Trading in a trending market requires a different approach than trading in a ranging market. Beginners often fail because they apply the same approach to all conditions. Another important concept is structure. Price tends to form patterns based on how buyers and sellers interact. Higher highs and higher lows indicate strength. Lower highs and lower lows indicate weakness. These simple observations form the foundation of market analysis. The key here is simplicity. Do not rush into complex strategies. Focus on understanding how price behaves. That understanding will become the foundation for everything that follows. Now that the foundation is in place, it is time to address the most important concept in trading from the very beginning: risk management. This is where most traders fail, and it is also where successful traders separate themselves from everyone else. Trading is not about making money, it is about protecting capital. That might sound counterintuitive, but it is the truth. If capital is preserved, opportunities can always be taken in the future. If capital is lost, the ability to trade disappears. Every trade carries risk. There is no such thing as a guaranteed outcome. Because of that, every decision must include a clear understanding of how much is being risked. Professional traders think in terms of percentages, not absolute amounts. They control how much of their capital is exposed on each trade. Now pay close attention here. Small losses are not a problem. Large losses are. The goal is to keep losses controlled and consistent while allowing profitable trades to grow over time. This creates a positive mathematical outcome, even if not every trade is successful. Beginners often do the opposite. They risk too much on each trade, hoping for quick gains. When trades go against them, losses become large and difficult to recover from. This is the fastest path to failure. From the very start, the focus must be on survival, not winning, not proving anything. Simply staying in the game long enough to develop skill and consistency. At this stage, most beginners start asking the same question: what strategy should be used? It's a natural question, but it's also where many people go off track. The truth is, strategy is important, but not in the way beginners think. A strategy is simply a set of rules that defines when to enter a trade, when to exit, and how to manage risk. That is all it is. It is not a secret formula, and it is not something that guarantees success. What matters is not the strategy itself, but how consistently it is applied. This is where most traders get it wrong. They jump from one strategy to another, constantly searching for something that never loses. That approach creates inconsistency, and inconsistency leads to failure. No strategy works all the time. Every approach has periods of wins and losses. The key is to stick to a structured method long enough to understand its behavior. Now, this is critical. A simple strategy applied consistently will always outperform a complex strategy applied inconsistently. Complexity creates confusion, and confusion leads to poor decision making. At this stage, the goal is not to find the perfect system. It is to find a simple, logical approach that can be followed without hesitation. That might involve basic trend following, identifying areas where price reacts, or understanding how momentum shifts. The exact method is less important than the discipline behind it. Think of your strategy as a framework, not a prediction tool. It provides structure, but the outcome of each trade remains uncertain. Accepting that reality is what allows consistency to develop. Once a basic strategy is in place, the next step is understanding execution. This is where theory meets reality, and it is often where mistakes begin to appear. Execution is the process of actually placing and managing trades. It sounds simple, but when real money is involved, emotions begin to influence decisions. Fear, greed, hesitation, and overconfidence all start to play a role. This is where discipline becomes non-negotiable. A trading plan must be followed exactly as defined. If a setup meets the criteria, the trade is taken. If it does not, the trade is ignored. There is no room for impulse decisions. Now pay close attention here. Most losses in trading do not come from bad strategies. They come from poor execution, entering too early, exiting too late, moving risk levels, or taking trades that do not meet the criteria. These are the behaviors that destroy consistency. Execution also includes managing trades after entry. Knowing when to take profit, when to accept a loss, and when to do nothing is just as important as the initial decision. Many beginners focus only on entries, but professionals understand that trade management is where results are determined. The objective here is precision. Every action must be deliberate and aligned with a defined plan. This is how consistency begins to form. As execution improves, the next layer to understand is performance tracking. This is where trading starts to become a professional process rather than a series of random decisions. Every trade should be recorded and reviewed, not just the outcome, but the reasoning behind it. Why was the trade taken? Did it follow the plan? Was the risk managed correctly? These questions provide insight into what is working and what is not. This is where most traders avoid the truth. It is easy to celebrate wins and ignore mistakes, but that approach prevents improvement. Growth in trading comes from identifying weaknesses and correcting them over time. Now, this is critical. A losing trade is not a failure if it was executed correctly. A winning trade is not a success if it was based on poor decisions. This is a difficult concept to accept, but it is essential. The focus must always be on process, not outcome. Over a small number of trades, results can be random. Over a large number of trades, the quality of the process determines the outcome. Keeping a trading journal is one of the most powerful tools available. It creates accountability, highlights patterns, and allows continuous improvement. This is how professional traders refine their edge over time. At this point, it becomes clear that trading is not just a technical skill, it is also a psychological challenge. This is where many capable individuals struggle, not because they lack knowledge, but because they cannot control their behavior under pressure. Losses trigger emotional responses, so do wins. After a loss, there is often a desire to recover quickly. After a win, there can be overconfidence. Both of these lead to poor decisions. This is where emotional control becomes essential. The goal is not to eliminate emotions, but to prevent them from influencing decisions. Trading must remain a structured process regardless of recent outcomes. Now, this is where most traders fail. They allow short-term results to change their behavior. A few losses lead to hesitation or abandoning the strategy. A few wins lead to increased risk and overtrading. Both scenarios create inconsistency. Professional traders think differently. They understand that outcomes vary in the short term. They focus on executing their plan over a large sample of trades, knowing that consistency over time produces results. Developing this mindset takes time. It requires patience, discipline, and self-awareness. But it is one of the most important skills in trading. Now that the core elements are in place, it is time to bring everything together into a structured path forward. Starting with no experience does not mean progressing randomly. It means following a clear, deliberate process. The first stage is learning, understanding what trading is, how markets move, and how risk works. This creates a foundation. The second stage is practice, using a demo environment to apply that knowledge without financial pressure. The third stage is refinement, developing a simple strategy and learning how to execute it consistently. Only after these stages should real capital be introduced, and even then it should be done cautiously. Small position sizes, controlled risk, and a focus on process rather than profit. This is how sustainable progress is built. Now pay close attention here. The timeline for this process is not fixed. Some people progress faster than others, but rushing the process almost always leads to failure. The objective is not speed, it is competence. Starting with no experience is not a disadvantage if the approach is correct. In fact, it can be an advantage because there are no bad habits to unlearn. The key is to build the right habits from the very beginning. This is how a beginner becomes a trader, not through shortcuts, but through structure, discipline, and consistency over time. As progress begins to take shape, the next concept to understand is the idea of an edge. This is one of the most misunderstood aspects of trading, yet it sits at the core of everything that works. An edge is simply a repeatable advantage over time. It does not mean being right on every trade. It means having a structured approach that, when executed consistently, produces a positive outcome across a large number of trades. Now, this is critical. Many beginners believe an edge comes from predicting the market perfectly. That is not how professional trading works. An edge comes from combining probability, risk management, and consistency. Even a strategy that wins only half the time can be profitable if losses are controlled and profits are allowed to grow. This is where patience becomes essential. An edge only reveals itself over a series of trades. Judging a strategy based on a handful of outcomes leads to incorrect conclusions. One losing trade means nothing. Even a sequence of losses does not necessarily invalidate a strategy. The real question is whether the approach makes sense logically and whether it has been tested across enough data to prove its effectiveness. This is how professionals think. They trust the process, not individual outcomes. Developing an edge is not about discovering something magical. It is about refining a simple, logical framework until it produces consistent results over time. Once the concept of an edge is understood, the next step is learning how to protect it. This is where consistency becomes the central focus. Consistency in trading is not about making money every day. It is about executing the same process repeatedly without deviation. This is far more difficult than it sounds because human behavior naturally seeks variation and reacts to outcomes. This is where most traders lose their edge. They start strong, following their plan with discipline. Then a series of losses or wins disrupts that discipline. They begin to adjust things unnecessarily, take trades outside their rules, or change risk levels. Over time, the original structure disappears. Now pay close attention here. Consistency is what allows an edge to work. Without it, even the best strategy becomes ineffective. This is why professional traders focus heavily on routine and process. They remove as much randomness from their decision making as possible. Building consistency requires clear rules. Entry criteria, exit conditions, and risk parameters must be defined in advance. There should be no ambiguity. When rules are clear, execution becomes straightforward. This is where trading starts to feel less like guessing and more like a structured activity. That shift is essential for long-term success. As consistency develops, the next layer to understand is position sizing. This is one of the most powerful tools in trading, yet it is often overlooked by beginners. Position sizing determines how much capital is allocated to each trade. It directly influences both risk and potential return. Managing this correctly is what allows traders to survive losing periods and grow during profitable ones. Now this is critical. The size of a position should never be random. It should be based on a fixed percentage of total capital. This ensures that no single trade can cause significant damage to the account. For example, risking a small percentage per trade allows for multiple losses without catastrophic impact. This is essential because losing streaks are a natural part of trading. Without proper position sizing, even a good strategy can fail. Beginners often make the mistake of increasing position size after wins or chasing losses after a losing trade. Both behaviors introduce inconsistency and increase risk unnecessarily. Professional traders take a different approach. They maintain stable position sizing regardless of recent outcomes. This keeps risk controlled and ensures that performance reflects the quality of the strategy, not emotional reactions. Position sizing is not about maximizing profit. It is about controlling risk in a way that allows long-term growth. At this point, trading begins to move from theory into a structured system. The next step is understanding the role of routine and preparation. Professional traders do not approach the market randomly. They follow a routine. This includes analyzing market conditions, identifying potential opportunities, and preparing for different scenarios before any trades are placed. This preparation reduces uncertainty during live trading. Instead of reacting impulsively, decisions are made based on predefined plans. This is a significant shift in behavior. Now, this is where most beginners struggle. They approach the market without preparation, relying on instinct or reacting to short-term price movements. This creates inconsistency and increases the likelihood of mistakes. A structured routine might include reviewing key market drivers, identifying whether conditions are trending or ranging, and marking areas of interest where trades might occur. The specifics are less important than the discipline of doing it consistently. The goal is to enter the market with a plan, not a guess. This reduces emotional decision making and improves overall execution. Routine creates stability, and in a field as uncertain as trading, stability is a major advantage. As everything begins to come together, it is important to understand how progress in trading actually works. This is where expectations must be managed carefully. Trading is not a linear process. Progress does not happen in a straight line. There will be periods of improvement, followed by setbacks, This is completely normal. Now pay close attention here. Many traders quit during these setbacks because they interpret them as failure. In reality, they are part of the learning process. Each mistake, each loss provides information that can be used to improve. The key is to approach trading with a long-term mindset. Short-term results are often random. Long-term results reflect skill and consistency. This is where resilience becomes essential. The ability to continue following a structured process despite temporary setbacks is what separates those who succeed from those who do not. It is also important to avoid unrealistic expectations. Trading is not a way to make quick money. It is a skill that requires time to develop. Those who approach it with patience and discipline are far more likely to succeed. Progress in trading is measured not just by profits, but by improvement in decision-making, consistency, and emotional control. These are the real indicators of growth. This is the stage where a beginner starts to think like a trader. At this stage, one of the most important shifts to make is moving from thinking about individual trades to thinking in terms of series of trades. This is where trading begins to resemble a professional discipline rather than a collection of isolated decisions. Most beginners place too much importance on the outcome of a single trade. If it wins, they feel confident. If it loses, they feel frustrated or uncertain. This emotional cycle creates instability. It leads to inconsistent behavior, which ultimately damages performance. Now, this is critical. A single trade is meaningless in isolation. It is simply one data point within a much larger sample. What matters is how your approach performs over many trades, not one. Professional traders understand this deeply. They think in terms of probabilities across a series. They know that even with a strong edge, losses will occur. Because of this, they do not react emotionally to individual outcomes. Instead, they focus on executing their plan repeatedly. This shift in perspective removes pressure. It allows decisions to be made logically rather than emotionally. It also reinforces discipline because the focus moves away from short-term results and towards long-term performance. Once this mindset is adopted, trading becomes more stable. Confidence is no longer tied to the outcome of the last trade, but to the consistency of the process being followed. With this probabilistic mindset in place, the next concept to understand is drawdown. This is something every trader will experience, and how it is handled will determine long-term success. A drawdown is a period where your trading account declines from its previous high. It is not a sign that something is necessarily wrong. It is a normal part of trading, even for highly successful traders. Now, this is where most traders get it wrong. They encounter a drawdown and immediately assume their strategy has stopped working. They begin to change their approach, reduce confidence, or abandon their system entirely. This reaction often makes the situation worse. Drawdowns must be expected and planned for in advance. This is why risk management and position sizing are so important. They ensure that losing periods remain manageable and do not cause significant damage. Now pay close attention here. The goal is not to avoid drawdowns completely. That is impossible. The goal is to ensure they remain within acceptable limits. This allows the trader to continue executing their strategy until performance stabilizes and recovers. Handling drawdowns correctly requires discipline and trust in the process. It is one of the defining characteristics of a professional trader. As understanding deepens, it becomes important to recognize the difference between learning and earning in trading. These are two distinct phases, and confusing them is one of the biggest mistakes beginners make. In the learning phase, the focus is entirely on building skill. This includes understanding markets, developing a strategy, refining execution, and building consistency. Profit during this stage is not the objective. However, many beginners approach trading with the expectation of immediate income. This creates pressure. That pressure leads to emotional decisions, overtrading, and excessive risk taking. Now, this is critical. Trying to earn before learning is one of the fastest ways to fail in trading. It forces decisions to be driven by the need for results rather than the quality of the process. The earning phase comes later. It is the result of consistent execution over time. When a trader has proven their edge, refined their process, and develops emotional control, profitability becomes a byproduct. Separating these two phases removes unnecessary pressure. It allows the learning process to happen properly, which ultimately leads to better long-term results. Another key concept to understand at this stage is the role of expectations. Unrealistic expectations are one of the most damaging factors in trading. Many people enter trading believing it is a quick path to financial freedom. They expect rapid returns, consistent profits, and minimal setbacks. When reality does not match these expectations, frustration begins to build. Now, this is where most traders fail. They chase results instead of building skill. They increase risk to accelerate profits, take trades outside their plan, and abandon discipline. This behavior almost always leads to losses. Professional traders have very different expectations. They understand that trading is a long-term endeavor. They expect periods of difficulty. They accept that losses are part of the process. Now, pay close attention here. Managing expectations is not about lowering ambition. It is about aligning with reality. When expectations are realistic, decisions become more rational. Patience increases and discipline becomes easier to maintain. This creates a stable foundation for growth. Without it, even the best strategies can fail due to poor behavior. At this point, the final foundational layer to understand is accountability. This is what ties everything together and ensures continuous improvement. Accountability in trading means taking full responsibility for every decision, not blaming the markets, not blaming external factors, but analyzing your own actions objectively. This is where real progress happens. By reviewing trades honestly, identifying mistakes, and making adjustments, performance improves over time. Without accountability, the same errors are repeated. Now, this is critical. Improvement in trading is not automatic. It requires deliberate effort. It requires reflection, analysis, and a willingness to confront weaknesses. Many traders avoid this because it is uncomfortable. It is easier to ignore mistakes than to address them, but avoiding them guarantees stagnation. Professional traders do the opposite. They actively seek out areas for improvement. They treat trading as a continuous process of refinement. This mindset transforms trading from a random activity into a structured skill building process, and that is what ultimately leads to consistency and long-term success. Remember to stop using the words "now this is critical" or "similar." It should all flow naturally understood. I'll remove those phrases and keep the delivery smooth, natural, and professional going forward. As the foundation becomes more structured, it is important to begin thinking like a professional rather than a beginner. This shift is subtle, but it changes everything. A beginner looks at the market and asks, what is going to happen next? A professional asks, what are the possible outcomes, and how do I position myself accordingly? This difference in thinking removes the need to be right and replaces it with the need to be prepared. Markets are uncertain by nature. There are always multiple possible outcomes. A professional trader does not attempt to eliminate that uncertainty. Instead, they define scenarios and align their actions with those scenarios. For example, if the market moves in one direction, a trade may be taken with predefined risk. If it moves in another direction, no trade is taken, or an alternative setup is considered. This approach creates flexibility without abandoning structure. This is how professionals maintain control. They are not reacting emotionally to price movement. They are responding to conditions that have already been planned for. The focus is always on execution within a defined framework. The focus is always on execution within a defined framework. This creates consistency, which is the foundation of long-term performance. Another important distinction at this stage is understanding the difference between information and insight. The modern trading environment is filled with information. News, opinions, data, and analysis are constantly available. The challenge is not accessing information, it is filtering it effectively. Beginners often consume large amounts of information without a clear framework. This creates confusion rather than clarity. Conflicting opinions lead to hesitation, and hesitation leads to missed opportunities or poor decisions. Professional traders take a different approach. They focus only on information that aligns with their process. Everything else is ignored. This creates clarity. Decisions are based on a structured understanding of the market, not on external noise. It also reduces emotional influence because decisions are not constantly being questioned by new information. The key is to simplify. Identify the factors that matter for your approach and focus on those consistently. This creates a stable decision-making environment. As the process becomes more refined, timing and patience start to play a much larger role. Trading is not about constant action, it is about selective action. Many beginners feel the need to always be in the market. They equate activity with progress. In reality, this behavior often leads to overtrading and unnecessary losses. The market does not always provide high-quality opportunities. There are periods where conditions are unclear or unfavorable. During these times, doing nothing is often the best decision. Professional traders understand this. They are willing to wait. They understand that their edge only appears under certain conditions, and they act only when those conditions are present. This patience is a significant advantage. It reduces risk, improves trade quality, and preserves capital. It also reinforces discipline. Waiting for the right opportunity requires confidence in the process. It requires trust that not trading is sometimes the correct action. This is a difficult habit to develop, but it is essential for long-term success. Another key element at this level is adaptability within structure. While consistency is essential, markets are not static. Conditions change over time, and a rigid approach without awareness can become ineffective. Adaptability does not mean constantly changing strategies. It means understanding when market conditions are different and adjusting execution accordingly while staying within a defined framework. For example, a strategy that works well in trending conditions may struggle in a ranging environment. Recognizing this allows adjustments in how trades are taken or even stepping back until conditions improve. This awareness comes from experience and observation. It is built through consistent engagement with the market and careful review of performance. Professional traders are not fixed in their thinking. They are structured but flexible. They maintain their edge while adjusting to the environment. This balance between consistency and adaptability is what allows long-term sustainability in trading. At this point, trading starts to become less about learning new concepts and more about refining existing ones. The focus shifts from adding complexity to improving execution and consistency. Small improvements begin to have a significant impact. Slightly better entries, more disciplined exits, improved risk control, and stronger emotional stability all contribute to better overall performance. This is where marginal gains accumulate. Each improvement may seem small in isolation, but together they create meaningful progress. Professional traders spend a significant amount of time refining details. They review trades, identify patterns in their behavior, and make targeted adjustments. This process never truly ends. Trading is a continuous cycle of execution, review, and refinement. The goal is not perfection, it is progression. Each step forward strengthens the overall process and increases consistency over time. This is what separates those who remain stuck from those who continue to improve. As everything begins to align, the focus shifts towards practical application. This is where trading becomes a real structured activity rather than a concept. The first step is defining a simple, repeatable process that can be followed every time the market is approached. This includes identifying the type of market conditions, checking whether a valid setup exists, and confirming that risk parameters are respected. Each trade should follow the same sequence. There is no guessing, no improvisation, and no deviation. This consistency is what turns knowledge into skill. Before entering any trade, there must be a clear reason for doing so. That reason should align with the strategy that has been defined and tested. If the criteria are not met, the trade is not taken. This level of discipline is what protects capital and builds consistency over time. It is also important to define what invalidates the trade. If the market moves against the position, there must be a predetermined point where the loss is accepted. This removes hesitation and prevents small losses from becoming large ones. Trading at this stage is no longer about learning what to do, it is about executing what is already known with precision and consistency. As practical execution continues, decision-making becomes faster and more refined. This is where confidence starts to develop, but it must be built on the right foundation. Confidence in trading does not come from winning trades. It comes from knowing that the process is being followed correctly. This type of confidence is stable because it is not dependent on short-term outcomes. Many beginners build confidence the wrong way. They feel confident after a series of wins and lose, that confidence after a series of losses. This creates instability and inconsistency. True confidence is different. It is based on repetition and discipline. When the same process is followed repeatedly and results are reviewed objectively, a deeper level of understanding develops. This allows decisions to be made without hesitation, not because the outcome is certain, but because the process is trusted. This is an important shift. It removes emotional influence and strengthens execution. Over time, this type of confidence becomes one of the most valuable assets a trader can have. At this stage, it is important to begin thinking in terms of long-term sustainability. Trading is not about short bursts of success. It is about maintaining performance over extended periods of time. This requires a balance between growth and protection. Taking excessive risk may produce short-term gains, but it almost always leads to long-term instability. Controlled, consistent risk allows for steady progress. It is also important to recognize the importance of stepping back when necessary. Fatigue, frustration, or lack of focus can all impact decision making. Continuing to trade under these conditions often leads to mistakes. Professional traders understand when not to trade. They prioritize clarity and discipline over constant activity. This protects both capital and mental stability. Sustainability also involves continuous learning. Markets evolve, and staying engaged with the process ensures that understanding remains relevant. The objective is not just to become profitable, but to remain profitable. That requires consistency, discipline, and awareness over the long term. Looking back at the entire journey, it becomes clear that trading is not about finding a shortcut or discovering a secret. It is about building a structured process and following it with discipline. Starting with no experience is not a limitation. It is simply the beginning of a process that, when approached correctly, leads to competence and consistency. The key lessons are simple but powerful. Understand how markets work, focus on risk management, develop a clear strategy, execute consistently, review performance, refine the process. Each of these elements builds on the previous one. Together, they create a framework that can be relied upon over time. It is also clear why most people fail. They skip steps, rush the process, and focus on outcomes rather than structure. This creates instability and leads to poor decisions. Those who succeed take a different approach. They focus on building skill, maintaining discipline, and thinking in terms of probabilities rather than certainty. This is what transforms trading from a gamble into a professional activity. Starting trading with no experience is not about where you begin, it is about how you approach the journey from that point forward. With the right structure, the right mindset, and a focus on consistency, it is possible to progress from complete beginner to a disciplined, capable trader. Not quickly and not easily, but effectively. The market will always present challenges. There will always be uncertainty. What matters is having a process that allows those challenges to be managed in a controlled way. Over time, this process becomes second nature. Decisions become clearer, execution becomes more precise, confidence becomes stable. This is the path that leads to long-term success in trading. If you take one thing away from this, it should be this minus focus on building the process, not chasing the outcome. Everything else follows from that. And if you are serious about becoming a trader, commit to doing it properly. Approach it with discipline, patience, and consistency, and the results will come as a byproduct of the process. Make sure to like, comment, and subscribe so you do not miss the rest of the video series, where each video builds on this foundation and takes your understanding to a professional level.